Picture this: you spend 10 years climbing the corporate ladder, reaching a prestigious senior title and a $150,000 salary. You feel unassailable. But at 9 a.m. on a Tuesday morning, a 10-second automated email revokes your access badge, cancels your corporate accounts, and instantly liquidates 100% of your household income. You aren't bad at what you do, you built your entire life on a single point of failure. Mainstream career culture conditions us to believe that a steady corporate paycheck is the safest, most responsible way to provide for a family. But that is an outdated illusion. You aren't foolish for seeking stability, you are caught in a structural trap that mistakes temporary corporate employment for long-term financial security. The issue isn't your performance, it's an asymmetric system where your entire economic life hangs on a single corporate balance sheet. My name is Nick, and I spend way too much time dissecting financial psychology, behavioral economics, and the invisible traps that keep smart people stuck on the financial treadmill. If you want to understand the real mechanics of money, cut through the noise, and build genuine financial autonomy, hit that subscribe button and give this video a thumbs up. Let's examine the structural data. In modern corporate environments, corporate restructuring, technological automation, and strategic pivots happen with zero advance notice. Yet, over 80% of high-earning households rely entirely on a single employer for 100% of their monthly cash flow. How do educated professionals fall into the single income trap? It begins with a psychological bias known as the loyalty illusion, combined with asymmetric risk. In behavioral economics, people naturally assume that dedicated effort creates reciprocal loyalty. But in corporate contracts, the risk distribution is deeply unequal. The company diversifies its risk across thousands of employees, while you concentrate 100% of your income risk on a single employer. When your entire lifestyle, your mortgage, vehicle leases, private tuition, and insurance is tied to one paycheck, your high salary becomes a gilded cage. Lenders approve massive fixed obligations based on your gross salary, forcing you to maintain that exact income level just to avoid insolvency. Your mind uses mental accounting to rationalize this fragility. You tell yourself, "My job is safe because my department is profitable," ignoring the fact that macro corporate decisions are made miles away based on shareholder margins rather than individual performance. Now, let's look at the cold, hard math that reveals the difference between single-income fragility and multi-stream resilience. Consider household A. They earn $150,000 from a single corporate salary. Their monthly net income is roughly $9,000, and their fixed overhead is $7,000. If that single paycheck vanishes, household A's income drops instantly to $0, while their $7,000 in fixed overhead remains. Within 60 days, their liquid reserves are wiped out. Now, consider household B. They earn the same $150,000, but it is split across three distinct engines: $100,000 from a primary career, $30,000 from liquid index dividends and real estate cash flow, and $20,000 from an independent consulting venture. If household B loses their primary job, their income doesn't drop to zero, it drops to $50,000. That baseline cash flow covers 70% of their essential expenses, giving them months or years of breathing room without touching their principal investments. That isn't an opinion. That is math being brutally objective. Household B built a resilient system, household A built a house of cards. When you concentrate all your earning power into a single corporate channel, you surrender your career leverage. You become risk-averse, unable to negotiate aggressively, speak up against toxic mandates, or take strategic hiatuses, because you cannot afford a single week of missed income. This constant underlying vulnerability keeps your nervous system locked in neurological survival mode. Chronic job anxiety keeps your cortisol elevated, ruining your ability to think strategically across multi-decade horizons. So how do you break the cycle? You do not do it by quitting your job recklessly tomorrow. True freedom requires constructing non-correlated cash flow engines. First, reframe your career mindset. Treat your primary employer as your largest client, not your sole financial identity. Deliver great value, but invest your extra hours into building assets that you own outright. Second, build secondary income streams that are non-correlated to your day job. Route your excess salary into dividend-producing index funds, income-generating digital assets, or independent consulting channels. Aim to cover your basic housing costs with secondary cash flow within 5 to 7 years. Third, decouple your personal self-worth from corporate titles. Real wealth is quiet, diversified, and independent. Fragile finances are loud and tied to a single employer's name tag. True wealth is option value. It is the ability to walk away from a toxic environment on your own terms because no single boss holds the key to your family's survival. Money isn't a corporate title or a single monthly direct deposit. Money is stored time, diversified cash flow, and future sovereignty. Stop risking your entire financial future on a single paycheck. Start building a financial fortress today.